Hi friends, once again welcome to MarketGurukul.com and to our free technical analysis Android app where we have more than 100 videos on technical analysis and how to trade. But those are in Hindi, so if you don't know Hindi, please don't install. This is basically a response to Mike Smith's question, one of our subscribers and viewers on YouTube. Mike has posed some questions and the answers to those questions will be kind of enlightening to us all. So let us go to Mike's questions. Actually, the videos that we are discussing here is basically two of my videos where I have shown that, I have taken random trades based on some stupid, logic. I mean, there is no logic to it. There was completely chaos. I took random 10 trades and showed that with risk to reward, you could actually make money because you are on the right side of probability. These are the QR codes to those videos, and also the links are in the description. Mike's question is basically that he has taken 10 different currencies and taken totally 30 trades. You could see here with 20 pips stop loss and 50 pips target. Okay, so the risk to reward is 1:2.5, which is pretty decent. And his question is that which is the best one, whether it's 1:2, 1:3 or 1:5. And even after taking 30 trades, Mike says that he has broken even. Actually, he is not making any losses, which is good, right? 30 trades, if suppose you are a newcomer, you understand that almost majority of the trades will be negative. Often people complain that the moment they enter the trade, the prices go against them. So if a system is working for 30 odd trades without actually incurring any loss, it is a promising system. So he would like to know how to optimize this. Okay. Honestly, Mike, the objective of that video was not to actually come up with a random trading strategy that makes money all the time, because that is too good to be true. And anything that is too good to be true is not true at all, right? So that again sounds like a holy grail, and I keep on repeating that there is no such holy grail in trading except money management and risk to reward. There is nothing that you could even come closer to being calling a holy grail. So let us see first of all, let's understand what is the objective of the video, some takeaways that we have. The first thing is that trading is a business of probabilities and not certainties, okay? The market is flooded with systems and strategies and, templates and logics, which most of the time they claim that they are, 100% true, and with a lot of research they have come up with this. I don't believe that, because not a single man, not a single expert in the whole world can come and tell me what the next candle is going to be. Nobody is certain about it. It's impossible to be certain, to call what the next candle is going to do. This is a business of probabilities, and the right thing to do is basically to stay on the right side of probability. And the only way you can stay on the right side of probability is by money management. Okay, so that's the objective. That was the main objective of the video, to convey and drive this point. Secondly, I wanted to drive another point, that markets don't necessarily move against you. Market moves on its own. I mean, they don't actually wait for your trade to enter and then they go against it. If that is the case, probably it's better, if you keep your friend to trade against you, he will always make money, because market always goes against you. Nobody can say in certain terms that whether markets is going to go in favor or against you. So markets don't necessarily move against you. It is your perception, because you enter in a trade from in a wrong way. Okay, that's the only reason. Risk to reward will double or triple your indicators and systems effectiveness and success. I mean, this is a point I wanted to drive, that even if suppose you have a simple trading system, your risk to reward and money management will make it even more effective. Got the point? Most of the time people say that 70% of the trades indicators are actually working. Only the 30% of those times when the indicators are not working, they make huge losses. The basic assumption in this statement is wrong, because if suppose you have had money management, then you would not have big losses when the indicators are not working. Indicators are like, thermometers. They give you the body temperature. They just indicate what is happening. They don't predict the markets most of the time. So if you have money management, then those 30% will be automatically taken care of and encourage you to take high probability trades. That is the ultimate stage or phase where I would like to see new traders to come in. That is to learn how to take high probability trades. Wait for those trades, wait for those setups, and then take. The moment you do this, the moment you realize this, I have some 4 or 5 videos basically showing you a simple strategy on how to take trades based on support and resistance. Even normal support and resistance will give you such a profound understanding of markets, how markets work. Someone said that trading is nothing but to buy on supports and sell on resistances. And even a simple tool like support and resistance and pivot tool gives you so much of insight, into the action of what is happening, that if you are ready to wait for those setups to happen, and if you have your risk to reward in place, it is almost magical. Let me show it to you on an EU chart. The objective of this video is not basically to form a strategy, but let us go and see what happens when you apply support and resistances. I will also have the links of those 4 or 5 videos that I made on, where I show that, I hardly take a 7 or 10 pips stop loss, and I put it in such a way that the markets find it difficult to come and hit my stop loss because they are near an established support and resistance. But let's go to the chart and find out what is happening. Now this is the latest Euro USD 1 hour chart. Okay, now let us just study this. I have applied a support and resistance. I don't know whether it is visible to you or not, but here you can see some lines. The blue lines are basically the pivot points of those particular day, and lines above the blue lines are basically resistances, and lines below the blue lines are basically the supports of those days. Okay, let's start from here. If you see, the markets were above the pivot line. The first, the third or fourth candle comes and closes above this resistance, and the next stop is basically the support, the resistance here, right? The R2, R1 basically, okay? And then it struggles here. It tries to break it for at least 3-4 hours, and then somehow possibly breaks this and goes directly to the next resistance. And from there, it gets rejected. It comes and falls here and rests here on this particular resistance. From there, it falls and almost reaches to the, the midline here, right? So the action, if you see in this particular day, was either here, kind of near this line, or then the action was here for a few hours, and then the action was here for a few hours, and then the action is here. If you could see here, again the markets are trying to actually, and then once this candle closes above it, it goes and then touches this again, right? Again goes up, the day gets over, and then it rests on this resistance and the day is closed. The next day, this is the pivot point and this is the resistance. All action for the first 6 or 7 hours is basically here. So if suppose, just a thought, if suppose you take trades near this place, okay, and if you short, your stop losses need not be very big. So your risk to reward can be even higher. 1:3, 1:4, or even 1:5 or 10 is also possible if suppose you have a fib levels, okay? If there is an established fib levels, I would go 1:6, 1:7, or 1:10. So the risk to reward depends on from where you actually enter. If you could see here, the action is here huge, 6-7 hours, and after that it comes down. This candle is pretty much resting on the pivots. The next one breaks this and tests this support and again goes back. The next one comes straight to the next support level. From here it bounces back to this support, okay? And from here the action goes back to this line. So if you would see that these are all the support and resistance lines are basically, kind of action lines where a lot of stop losses are getting triggered, a lot of new orders, pending orders are there, a lot of take profits are there. So what happens is basically, these are the levels where basically a lot of trades come in, and it is difficult for the markets to go and close above this established supports and resistance. Why? Because there is a lot of volume that is required to breach those levels or close above them. You can see it again falls back to this level, goes back, the action is here, the day closes. The next day, the first candle closes below the pivot, comes straight here. The markets are resting here for a while. The next candle closes, rests here. The third one closes, just breaks this one. The fourth and fifth one closes, just breaks this one, and then they go and rest here. So at every line, if you could see, these are the lines that actually stop the markets from moving faster, at least, right? So these are the resting points for the market. So if you start taking trades from here or from above the lines, you are taking a high probability trade. I have a few videos. As I mentioned, the links are in the description. You can watch them. Have a look. This is the line of action. The next time, okay, the next day opens up, breaks, goes straight to this, tries to break it, comes back again, right, pretty close to this market, opens the next day, the first candle opens, kind of closes above the pivot line, goes straight to the next resistance, and then goes straight to the next resistance. The action is here, falls from this place, directly comes to pivot, goes back again, goes and gets rejected at the resistance. From there it falls straight to the support, then falls straight to the next support. Action is here, this one tries to touch this, gets rejected from here, gets up, comes back, rests here, rests here, and then if you could see all the action that happens basically on a simple support and resistance tool, you could see, right? This one closes above, goes straight to the next support, goes straight to the next support, and goes straight to the next resistance, right? The next day, again the same thing. It rests here, tries to break this, but every single time it tries to break it, it gets rejected, comes down and rests on the pivot. So this is a simple tool. Now, if you start taking your support, your trades based on this tool, then your risk to reward could be better. So randomly, imagine if you're taking a random trade here. On that day, I was, those random trades gave me two trades. One was way above the, it was almost looking like an all-time high, and the other one was basically, I was getting a short call below the all-time low. The take profit for the short was below the entire week's low. So those are illogical trades, and those kind of trades will actually sabotage your profit in a random setup. But if you take trades which are high probability trades based on a simple logic, maybe it's a support or resistance or maybe something else, the results will be remarkably different. And not to forget some occasional, such candles which will go against all logic and take your stop losses out. So never to worry about this exceptional, candles. So what's the best risk to reward? As I said, it all depends on the pair, the stock, the commodity or symbol. Doesn't matter in which particular markets you are trading, whether it is in stocks or currency, the same thing. You need to understand the pair. Some of the pairs or some of the symbols or the stocks, actually they have a lot of vibration. I call them vibration. The range. What happens is basically, say for example, GBP USD, Euro GBP. These are the pairs where you have very less volume, and that's the reason why what happens is basically that they vibrate a lot. By vibration, what I mean is basically that without even moving, in one particular direction, they would go both ways and kind of hit your stop losses or take profits, depends on your luck. But basically, these are not the right currencies to trade. I'm not really very comfortable in GBP USD and Euro GBP. GBP USD has given me the most losses in my life. There was a time I used to hate GBP USD like anything. Okay, so compared to Euro USD or USD JPY, these are the pairs where your logics will often fail. So don't get into all those currencies. Have few of the good currencies, the major pairs, and you will enjoy. The third thing is basically the timing of the trade. USD JPY, I would love to trade USD JPY when the Japanese are trading and nobody else is trading. Just follow Ichimoku. Trust me on this. The Japanese are so predictable. While the only Japanese market is, because 73% of all Japanese people actually use Ichimoku. So if suppose the price comes and rests on the cloud, you can go long or you can go short, and you'll be sure that at least one or two candles, most of the time, nobody can be sure, most of the time, basically it follows Ichimoku to the T. So the timing of the trade is very important. Euro USD, I would rather trade in the London session or basically more preferably in the American session. And in the American session, yes, I can actually go with a higher risk to reward, because the moment, if suppose you are kind of on the right side of the trade, the movement could be easily, 50, 60 pips. So I would say Euro USD, if you want to do intraday trading, then the best time to trade is basically in the US session. Or if suppose you have some good news, the London session as well. This is my experience. Not something, not as a rule basically. So you could also try to find out, those symbols which are pretty predictable in a particular timing. Again, as I told you, established support and resistance levels also decide the best risk to reward. If suppose I have, if I see 2 or 3 candles struggling on a support, and if I'm planning to take a long call there, probably I will go with a very tight stop loss, and the risk to reward would be 1:5, maybe till the next resistance or support. So that depends on basically where you take the trade and not on the randomness. The idea is not to give you, a random trading strategy basically. The idea is that you go to the next level where you take non-emotional trades based on some simple logic, not complex, right? Not too many candles, indicators and systems, but simple systems, 3-4 indicators, and that's it. The idea is basically to make the markets work hard to hit your stop loss, and the best way to do is basically to keep the stop losses, beyond established supports and resistance, and make it easy for the markets to hit your take profits. The meaning of this is basically that you put the take profits in such a way that they are a little bit above or below the next resistance or support, so that without exerting much, your take profits will hit. So again, the best risk to reward will depend on case to case basis, but anything above 1 is must, because unless you don't have a risk to reward of 1:1, you are in danger. Probabilities are against you. So 1:1 is minimum, and then it all depends on basically case to case basis. The conclusion is basically that, again, I'll just run it through. It puts you on the right side of probability. Have a simple strategy that gives you high probability trades. And we used to have this advertisement of a motorbike called Hero Honda, which they claim that it gives a best mileage. And they used to say, fill it, shut it, forget it. It has to be an emotional less trading where you just fill the stop losses, take profits, and then you shut the system, your trading terminal, and forget about it. Either it hits the stop loss or it hits the take profit. This is the best way to trade. You need to get to that point to be profitable in the long run without actually being nervous and anxious of what the markets are doing. The only way that can happen is basically to have a strict money management, never to have trade more than 3% of your capital. Secondly, to have your risk to reward properly in place. And take 100 trades on it, and you will actually marvel at the beauty of risk to reward. It's amazing. It's almost like magical. Okay, it's out of the world. If you do this, you will understand it's just out of the world. Sorry for a long video. It seems I have spoken a lot. This is my first English video basically, and I never done an English video because I was always having this complex that probably my English is not good, my accent is very thick. I'm still right this very moment, I'm afraid that probably you would not understand anything and you would be asking, hey Edward, did not understand even a single word of what you just said. Better to have your Hindi videos. So we'll come up with few more videos, if needed. And let me know if suppose any one of you comes up with a good strategy, something that works for you, and we are all here learning and sharing together. So I would certainly like to know if suppose you have a good system in place or a strategy that you found out which are working in stocks, commodities and currencies. So God bless you all. Have a great week ahead. God bless you.